if you've got trial or you've got market proving activity going on there, what happens if you just withdraw the product? If you tell customers we're not going to provide this anymore and they say, yeah, fine, you haven't got product market fit. If you say, I'm going to withdraw this product and the customer says, please don't do that, we need this product, we love it, we recommend it to everybody else, this is the best thing we've ever seen, you've got product market fit. You've got product market fit.
Hello, and today we have Neil Stephenson on the show. With a strong background and passion for tech, which started at a young age when he got busy writing lines and lines of code for the BBC B computer and ZX Spectrum in the 80s and 90s. Many years later, he went on to found, build up, and eventually selling Onyx, an IT services business based in Teesside for £65 million. Neil is now a serial investor, a non-executive director and board advisor. He has invested in more than 20 tech companies to date and sits on the board of half a dozen companies. So welcome, Neil. Thank you so much for being a part of this.
Thank you for having me.
Cool. Well, this podcast is for founders who want to raise investment or are thinking about it. And I think it's really, really interesting with this particular show because you're not only an investor now, but you've also been in the position of being a founder. And not all investors have that pathway. So I'm really interested to hear both sides of it and a little bit and how that's maybe affected your perception of new businesses that you see or investment decks or anything that you come into contact with now. So I just want to talk a little bit first about an initial approach, because I'm sure you get a lot of approaches being an investor that people want to talk to you, want to get you involved in their company. And I just want to talk about how does that initial approach normally go? Is that a LinkedIn message? Is it an email? Is it a phone call? Is it from another investor? How do you normally hear about other companies?
So you know what? I get reach outs from a whole bunch of different ways.
Right.
So lowest on the list of things where I get a reach out is LinkedIn. Typically where somebody would connect with me. I think, oh, that's interesting. And immediately afterwards, without any chit chat, without any conversation whatsoever, the first thing that comes says, I'm looking to raise money. Here's my deck. And I always look and think, that's rubbish. That's really poor. You haven't took the time to understand who I am or what I do or how I do things. And, you know, the classic thing people buy from people they like. I haven't even had the chance to get to like you before you've sent me a deck. So that's the poorest kind. Then I get referrals from people who already know me, individuals, entrepreneurs, people who've seen the success I've had and the things that have gone well or not so well, the professional advisors that point me in the right direction. And then ultimately, at the very end, I get called people who don't know me. So I get a whole range of different things. People come up to me at events. People send me mail. I probably get 10 a week.
Yeah.
10 different things every week.
Has there been a cold approach that has instantly sparked your attention, even if the approach was a bit direct?
So I had a guy sit next to me on a train. And that was quite interesting because 10 minutes into the conversation, he was asking me what I did and I was asking him what he did. And that was quite interesting. We didn't do anything in the end, but that was quite interesting. I had a guy who came to I was speaking somewhere and a guy came to see me to the event. He didn't come to see me speak at the event. He came to talk to me about investment. And I thought, wow, you've gone to the effort to come and physically, when he could have just sent me something, he actually came to see me. And we've done quite a bit of stuff together since then. But I was really quite impressed by the fact that he'd just come to see me. He really made the effort to hunt me out. He knew a bit about me. He was local to where I was, and he just took the effort in a world where you really get a lot of cold people just chasing you. I'm going to be the next big thing. I'm the Uber of this or the Amazon of that. When somebody takes the effort, it really makes them stand out. And then he didn't even pitch me anything for a while. He just got to know me. And then by the time I liked them, I was thinking, I'm going to do whatever you're doing because I like you. So
That's
yeah,
interesting.
yeah, it is.
I've heard that a few times, that when people really make the effort, and I'm wondering, like, what is it about that, or how can people improve their skills in that? Because the thing is, when you're doing fundraising, obviously there's a lot of investors. You need to get it out to a lot of people. You need to spread the message. And is there a way that founders can do that, or is there a way that they can kind of build a relationship in a short space of time with you, or has there been an occasion where, you know, an approach has kind of advanced to the pitch deck viewing level at a faster rate?
So let's answer that question a different way. Okay. So anybody who's looking for an investor needs to really appreciate the fact that this is like getting married. So this is a long-term commitment, because everyone's got money. Everyone's got money. There's so much money out there. So if you're looking for an investor, it's like getting married. And I don't know what you did, but when I got married, I didn't stroll across the dance floor, buy my wife a bottle of Budweiser and say, would you marry me? I just didn't. It took quite a bit of time before I worked out that that was the right person. And I think it's the same thing when it comes to investing. That person actually needs to spend the time to be able to get to know whether I'm the right fit for them and they're the right fit for me. And ultimately, and really ultimately, at 10 o'clock on a Sunday night, if that person calls me, I need to want to take that call. So if I was to look at my phone and think, oh God, it's them, I'll speak to them tomorrow, I've invested in the wrong thing. Because I'm really investing in a business, but a person or a team. I'm not really investing in a business, because the people are the team. So getting to know me and understanding that fit, and also understanding that not everyone's the right fit. You know, I'm definitely not the right fit for everybody. Definitely. There is a distinct set of people that I fit really well with, a distinct set I don't. So fit's really important.
Absolutely, yeah. So what's a good way for a founder to learn about you if they're not connected to you on LinkedIn? Are you in any other databases? Is there like a public record of things that you invested, or how can they get to know you and then get that approach right?
Well, I mean, they can watch numerous podcasts that I've been on and I'm currently on at the moment. So that's a really good way of finding out what you like.
Yeah.
And then I think getting in touch, but the first touch is just about trying to understand where there's a fit.
Okay.
As I say, I hate people who they connect with you on LinkedIn and the first thing they say is, we develop software. Can I develop some software for you? Or we do marketing. Could you want some more leads? It's who does the energy buying in your business? It's just such a poor. You almost press the delete button straight away. And I'm really interested in building relationships with people. People I like. That's really important. So there's a maintenance here. And if you haven't got the time to do that, you're not the right investee for me. And I'm not the right investor for you. And never do things quickly. Don't get married quickly, because divorce is dead expensive. Just is.
Yeah. I mean, it kind of comes. I mean, for founders looking to raise, it's a full-time job. It's a full-time sort of marketing job. And again, this sort of brings me back to your history with Onyx and your experience as an entrepreneur, because I'm sure that you would have launched cold email campaigns and marketing campaigns. And can you see a relationship between founders' outreach to you and possibly what you've done in the past? What's been successful and unsuccessful with your own outreach and marketing? Yeah,
right. So let's talk about sales cycle, because that is really what we're talking about here. So I sold into the business-to-business market. It's a market I know really well. It's a market I've had a lot of success in. Sales cycles, 3 months minimum, 6 to 9 months on average for quite a lot of this type of stuff. So if that's your sales cycle, if that's how long it takes to do stuff, sending somebody an email saying, do you want to buy this today, is the stupidest email ever. And I never did that. So I was always warming people up, kind of getting people into various sales funnels and trying to get them to understand whether they were the right fit for us and we were the right fit for them. And then timing, you know, when's the right timing for them? So I was into qualification in a big way there, trying to build long-term relationships. At the end of the day, David, if somebody said to me, I don't want to do something, I just took it as they don't want to do it now. Wasn't it they don't want to do it, they just don't want to do it now. And I haven't provided them with enough proof that they need to do it now and with me. So that sales cycle, that gestation period, that itch period, whatever you want to call it, has a length. Why would it be any different when you're trying to raise funds? Why would it be? Why would you expect me to write a check for 50 or 100,000 pounds based on one cold email and a couple of chit chats? I don't think so.
Yeah, and I find that, I mean, this is sort of a common thing that I've heard a lot in business, that the bigger the transactional amount, the longer the sales cycle. And
so I'm not into big amounts. I'm not that person. I'm the first money. I'm the first investee, and I'm there's obviously risk there. I'm interested in helping that person to develop their proposition. So if somebody come along and say, I've got a very clear view of what we're doing, I'm looking to invest and raise immediately, that's okay. I'd much prefer someone to say, I've got this idea I'm developing and I'm thinking of raising some money in the future. I'm much interested in having that conversation.
Okay.
Because I can either help and input or steer and guide as to where I think the opportunity could be. So the earlier, the better. And sometimes you say to people, I really like you, but I don't like your idea. And then sometimes you say to people, I love your idea, but you're not the right fit for me. And both of those things are really good feedback from an investor and an investee. That's the right feedback to receive. And over the years, as I've raised funds, I've had that lots of times. If you expect 100% hit rate, you're mad. No chance. Lots of people we've already got something in that sector. We've invested in something just like that. It's too far away. It's the wrong proposition. It's B2B. We do B2C. There's plenty of reasons not to do it, but I only want one. You only want one early investor, one or two.
So what is it about the idea or something that comes to you? What's the first thing you look for in a potential investment opportunity in a business?
Oh, so it's dead easy. Dead easy. Difficult to replicate, but dead easy. I've got to like the person.
Right.
First of all. Because the person's just everything. Anybody can have an idea. But in fact, anybody can recycle somebody else's idea. It's whether that person can execute. Whether they can take that idea and turn it into reality. Because I'm not going to, as an investor, I'm just going to provide some of the fuel. So I've got to believe that that person's actually going to be able to execute, going to be able to do it. And therefore, that's the early stage. Because even if they've got the best idea, if they can't do it or they're not very good, then you ain't going to have success. And starting businesses and creating them and getting scale is really hard. Really hard.
It is very hard. I mean, so let's drill down to that then. So what characteristics in that person or how do you know that they're the right person? How do you know that they like them? Because you can like someone, but then how do you know that they're any good at business? Is it track record? Is it what they say? Is it how they present themselves? Is it, tell me about the person.
I don't think there's one thing. I like people who answer straight questions. I like people who are bright, which isn't intelligent, but I like bright people. People who are thoughtful, who take feedback really well, who are prepared to debate points. I don't like people who've got closed positions on things. Because you might be wrong. You might just be wrong on something, and I prefer people to say, you know what, that's a really interesting point, and that I'll need to think about that. I'll need to reflect on that because I might be wrong and you might be right, Neil. So I like that type of dynamic. The fit with me is important. So not like me, but just the fit with me. Is this somebody who's going to take what I think and put it into the mix? Or do they just want my money? If they just want my money, I'm not the right fit. Because everybody's got money. That's not a differentiator at all. They've got to want me, and I'm an unusual character. So they've really got to want me. I've got to feel like we're going to work really well together. That I'm going to enjoy. I work better with extroverts. I do like extroverts, people who get the energy from other people outwardly. outwardly positive, more commercially focused, more. I like people who think about markets rather than marketing. I like the conversation around total addressable market and scale and phases of growth. I prefer those type of conversations. I can see, my ultimate outcome in any investment is, if you just want to get your money back, that's madness. So what you really want to do is every now and again, you want to hit the ball out the park. You really do. You want to have a big win. So I've got to be thinking about total addressable market and markets, not marketing, and just how we scale this thing. If that principle's got those ideas in mind and can answer that question, that's where I'm after. Do I want somebody where there's no risk? Well, risk and reward are part of the same continuum.
Yeah.
So I'm happy to understand what the risk is. I'm happy that that person understands it. Somebody who builds teams, somebody who's going to look good in front of a customer, somebody who's going to work well with me. The basic things like trust are just a given. You have to trust the person.
And how does that come about? Is that through conversation? Is it through what you read? Is it through mini due diligence that you do on your own back off having first been introduced to someone? How does that how do you decide those factors?
It's face to face over a number of times, a coffee, a beer, some lunch, a period of time, an understanding of the other people in their ecosystem. So I might go speak to somebody who knows them and ask a bit more. This is, I've said it before, but this is like getting married. You're permanent long-term capital into these things. You're not a short-term thing. There's no protection. So I've got to be sure this is the right person. And it does take a bit of time. And I'm probably looking all the time to qualify people out, not in.
Yeah.
I'm probably trying to find ways not to do stuff because there's just so much to do. You can't do everything.
Okay. So they've impressed you with an initial approach, which is about you and your background and what might be a good fit. They've impressed you by presenting a good idea. And then at that point, say that's on email, would you launch into a call with them, or would you first read their pitch deck proposition?
So I'd always want to read the pitch deck. So I've got a couple of things that are quite important. So I like to be geographically close to these people. So I don't mind London because it's not hard to get to and I'm there reasonably regularly. I live in the Lake District, so that's quite helpful. And I live in Sunderland, so I go back and forth between the two coasts. So an hour commute around all those areas works for me. But I do like to get FaceTime with people. I don't love email, and I know we're on a Zoom call today, but that's just for convenience. But from an investment point of view, I like to be geographically close to that person. I think that's really important. And FaceTime is really important. So I want to meet that person, look them in the eye. These type of communication methods are helpful when you know the person. Find it difficult to build a relationship with somebody unless I'm face to face. I just do. So it's got to be face to face over a period of time. I've got to get to know them. They've got to get to know me. And then you're into the little magic bit, which is, I like this person. I like the idea. Part of the I like the idea is I know something about this market and I think I can help. So, most successful investors, most successful entrepreneurs go back to the same well over and over again. And the reason for that is because that's the market they know.
Yeah.
They know it well. I know B2B tech. I know software, I know telecoms, I know IT infrastructure. That business to business bit is what I know. I don't understand hardware. I don't understand consumer stuff particularly. I've never done retail ever. There's a whole bunch of things that I just don't know.
Yep.
Never run an accountancy or legal firm. So there's a bunch of stuff I know and a bunch of stuff I don't. And if it's right in the middle of my area of expertise, my domain knowledge, that where I've got a network, where I know people, where I have something to bring to the party other than money, then that ticks a box, and it has to tick that box.
Do you think that your background in being a company founder and building up a company has shaped your investment persona, just in the way that you're saying these things, like you have to go and meet them, you want to be actively involved in the business, you want to come in at a much earlier stage. You're not maybe so worried about traction, you're more thinking about relationships and people and the idea. And I just from the other investors I talked to, it's actually quite a unique perspective. And do you think that's come from your business background, your entrepreneurship?
David, I'm very different. Different's a good description for me. I'm different in every regard. So I wanted investors who brought more than just money when I was building a business. When we were doing that type of thing, I wanted people who could add to that. Otherwise, it's just the money. When I'm doing what I'm doing now, I want to add more than just the money. It protects your investment position. It gives you some understanding of what's going on. It means potentially you can avoid people making big mistakes. There's just a bit more to it than just the financial piece. If you've just got the financial piece, then you really are into just a portfolio and a spread and markets, and let's hope it works. I prefer to be a bit more targeted. I think that's where I benefit.
So you've met the person, you like them, you've read the deck, you've had several meetings with them, and you've decided that you want to go into business with them. Tell me about the due diligence process at that point. Is that any different, or has that been gradually built up to that point? Because a lot of founders, they have to prepare a lot of these documents, and I just wanted to talk about, because a lot of founders I speak to, they don't realize how much due diligence goes into an investment. So I just wanted to get into that detail a bit more.
Yes, I mean, if you're doing bigger transactions, then diligence is really important. It's less so, and it's more me doing it than anybody else. So I might go and talk to some people I know to get a bit of feedback, but I'm reviewing business models. I'm thinking about any legal stuff. I'm thinking about commercial pricing, stuff like that. I'm testing that out. That is me and the investee. That you've got to do the hard yards there. I don't really want a report from someone that says this is a good deal to do. I want to do the work myself with the person or the team. I think that's really important. I think I'm intuitively know target market, size of customer, spend, growth rate, all that type of stuff. I think I can do a reasonable stab at that. There's typically, when it's a new thing, there's not loads of legal diligence. There's a bit of shareholder agreement. There's a bit of protections I want in there, but nothing difficult and similar to what other people like me would do. If there's an investment wrapper that I'm coming into, like EIS or SEIS, I have to protect my position there. Other than that, it's relatively simple and straightforward, I think, and relatively quick. And
I presume, I don't actually know this, but I presume in your journey with Onyx, you were involved in raising then, is that right? On the other side?
Yeah, a few times.
And tell us about that, because that's really interesting to see that from both sides, because I'm talking to a lot of founders that have gone through that raising process. So I'd love to hear a bit about that sequence of events and how that came about.
Yeah. So the things to remember are different investors at different times. Yeah. And each investor's got their own horizon. So there comes a point where you, as an investor, you've achieved what you wanted to achieve. So normally you're not into permanent 25-year hold for it. If you can invest, the business can grow, and there's an opportunity to exit, that's what works for an investor. And understanding that early doors is really quite important, because they've got a journey, an amount of time, a bit of runway, if you like. And at the end of that, you need different investors. So either the investors you're currently working with just can't follow on anymore. They can give you 50,000 or 100,000. When you ask for $1 million, that's just not what they do. You need somebody different. And typically the people who come in at the early stage, when bigger people come in, they tend to want to be bought out as part of that. And I think that's fair. So understanding how you cycle investors in and out at the right point, I understand and have been through that journey. And every investor who invests with you, you're hugely appreciative of all the support they've given you. and you accept that all things come to an end. And as long as you give them a good return, that's good.
How did you learn about that then? Because I presume did you learn that from your first investor at Onyx?
You just learn, as you understand people's motives and motivations, and there's a bit of value being created here, and it's probably the right time to exit. When there's an opportunity to exit, do you want to carry on? Probably not. You just understand through those conversations that actually people run different bits of the journey. If it's a 1,500-meter race, not everybody runs the whole race. Somebody does the sprint at the end, someone does the bit at the beginning, someone does the middle. It's just different. They've got different firepower, they've got different motivation, different horizons. And I think as you go through that journey, you just understand it. You just appreciate that you now need a different level of sophistication. I probably don't, as I get bigger, I probably didn't want 10 investors. I wanted one bigger one.
Right.
Just one person to talk to. It's easier. It's just a different investor. So you do learn that. You do learn, and you learn to appreciate people for what they give you at that time. And you recognize when it's time for them to go back to the beginning with somebody else.
But did you raise with that in mind? Like you knew that you needed that first level investor, and you built a structure for. I just want to sort of understand all these different stages, because I think that a lot of founders, they're kind of a lot of them are early and they focus on that first stage, and they might not think about the raises to come. So were you aware of the following raises that you needed to do, or was it more of an organic thing that as it grew you thought, okay, I need another investor now?
Yeah, I probably wasn't aware at the time, because you're always looking for the next thing to do. I think the thing to always remember when you're a chief executive of a business is you can't get to the stage where what's called the cap table or the list of shareholders gets to the stage where the management team have got nothing, because actually nobody wins at that point. So raising too early and too much equity doesn't work. It just doesn't. It means in the end, by the time you've done a bit more, there's nothing left. So you've got to be so careful how you do that. And I didn't appreciate when me and the rest of the team were doing the Onyx journey that was the case, but you just evolve over time. You just recognize the fact that you've got to make sure that there's enough left for management and enough left to make all the hard work worthwhile, but also make sure you deliver for your shareholders.
So how did you know what the right amount was to ask for, and how did you know how to manage that in the future at the time?
Yeah, I mean, there's some obvious rules of thumb about what your return's going to be, and is it going to be worthwhile? And as you're raising, as the value going up, nobody wants to do what's called a down round. Nobody wants to do a bit where they've raised at a value less than the previous one.
Yeah,
because everybody just dilutes and it just becomes difficult. And you've always got to look ahead and think, I can get to a point where equity value is this, and that will be good for me. And if it's good for you, it'll be good for all other shareholders. So you've got to have that kind of balancing act in mind. You really have it at all points in time. Otherwise, you'll get out of kilter. I wouldn't say, David, that we did that with a grand plan.
Right.
But I think intuitively, as you're in the middle of that, you recognize at each point in time, if I want to do this next thing, this is the size of the opportunity. And this is probably how much capital I need. And this is probably how much, providing the valuation's right, this is how much I'm prepared to give up to do that. That, you probably just do that intuitive calculation to work out whether you think it's right. And clearly, if you have to give away too much and the return's too little, you naturally don't do it. Why would you?
Yeah, I'm just looking for bits of gems of advice, really, for founders at the moment who are maybe struggling with their valuation or struggling to even think if it's a good idea to raise. Have you got any specific tips or like a checklist for people that are starting to go into that raise? Now you're on the investor side and you've been through it from the founder side.
Yeah, so there's a bit at the beginning called product market fit. Yeah, so you're in this, you've got this idea. You think you've got the right product, you think your first market's identified and you're trying to do that. You've got to prove that before you grow and scale, because you might grow and scale in the wrong market. And I see a lot of people who look to raise funds before they've really proven that product market fit.
Yep.
But they're doing that because it's a loss-making business and they just need the fuel to keep going. But actually, you've got to nail the product market fit. If you know that's the market, I've had success in it, this is the proposition, we've proven this, it's a much better story to crank the handle and say, if I get some more marketing dollars, this is how quickly I can grow into this market. Whereas if you're still trying to figure the market out, that can be an expensive exercise, and you might be better off not scaling until you reach an answer on product market fit. It's probably, if you were to ask me for one bit of advice, I'd say get the product market fit proven before you raise capital to scale. Otherwise, in the end, you'll either run out of runway or the cap table will be so broken it won't be worth its while to do that.
Yes, absolutely. I mean, I always talk about that, and when I talk to founders, I always talk about getting the traction right, which is the same kind of thing, really, isn't it? I mean, but I wonder if there's some techniques and ways that you can advise on companies that have great ideas. They might be at MVP or even pre-MVP, and are there ways to determine product market fit or traction or demand even before you have a finalized product?
So a couple of bits of really great advice here, right? In the tech space, I think, but maybe elsewhere too, you should always be mortifyingly embarrassed about your product. Because if you're not going quick enough. And the big tech companies are great at doing this. They'll launch something full of bugs and version 1's horrible, right. Version 2's okay, and version 3's better. There's no point in having version 3 if you haven't proven that there's a market there. There's just no point. You may as well have version 1 and off you go. The other bit to go with it is if you've got trial or you've got market proving activity going on there, what happens if you just withdraw the product? If you tell customers we're not going to provide this anymore and they say, yeah, fine, you haven't got product market fit. If you say, I'm going to withdraw this product and the customer says, please don't do that. We need this product. We love it. We recommend it to everybody else. This is the best thing we've ever seen. You've got product market fit.
That's a good one.
If you haven't got that, you haven't. So they're the two things I would recommend people do.
So a lot of people, a lot of founders I've heard, they're almost a bit protective about it. They don't want to expose it to the market because it's not ready. They're worried about competition and things getting copied. You're saying get it out, warts and all, bugs, everything. See what the reaction is in the market and potentially get your customers to tell you what to fix. Is that some good advice?
Absolutely. I think, I think that's where I'd be. I would. That's exactly where I'd be.
They launch it, warts and all.
Yeah, why not?
Okay, great.
So the other bit to add to that, because there was a point that's for further discussion, I think. So you often get a pitch, and the pitch says, "I've got no competition." That is the worst thing you can ever tell any investor. There's no competition.
Yeah.
Because bearing in mind what you're saying to an investor gets interpreted. So all I hear when I say there's no competition, I just hear there's no market.
Yeah.
Or it's so bloody small. Or niche. It's a niche market. So what we mean is it's an irrelevant small market. Whereas if you said it was a specialist market with discerning buyers and premium pricing, I'd be interested. Whereas if you said there's no competition or it's a niche market, all I hear is there's no market. Because not everyone's a genius, and you really want a market that's growing quickly, that's really big, that lots of people think is a market. And then it's about execution. Can you execute? And if you can, you win. If you can't, well, that was why you failed, not because there was no market.
And is that something that comes up in the pitch deck or in a conversation, or is that just an immediate red light alarm bell turn off, or is it something that you can challenge and push and say, oh, actually, you do have competitors and here they are?
I just think it's a really basic, naive daft thing to say. I just look and I think, oh, okay, no market. We've got no competition. You're like, great. So you don't need an investor because this is the greatest market ever. You just crank the handle off you go, guys, girls. It's a poor thing to say. Poor thing to say, I think. I'm sure you.
What makes something like good timing or a good fit for you? Is you're talking about timing in terms of getting in terms of investment. So what is a good time? What is an optimal time for someone to reach out? Say they've got product market fit, and is it on the brink of? I mean, I always say to sort of the people that I work with is like, are you on the cusp of something? Has something big just happened? Is it just a question of money will allow a bigger growth, or what can you tell about timing of going to investors?
Yeah, no. So I like to be able to look at something as it's going through that phase. Right. The earlier the better. I like people who come back to me every few months and tell me what's going on. I think that's quite interesting because that builds a bit of credibility. This is what I'm going to do. This is what I have done. I think that's quite powerful. That's quite useful. I like you get confidence from there. You get comfort. You get to maybe provide some input and shape things and build your relationship with the team. And then I think there's a natural point where there's either some capital required and you've got sufficient confidence that this is the right thing to do and you're the right fit with them and they're the right fit with you. I think there's just a natural point where that's the case. I guess where I don't want to get involved is where there is millions of investment rounds.
Right.
Where people say things like, I'm raising the first money, I need £1 million. I've got 600 of it, I need another 400. You just look and think, well, I'm going to be irrelevant here. There's no point in doing that. I don't want to be in that raise. That's not I want to be earlier than that. And I always think, why do you need £1 million? It's a nice number, but why would you need £1 million? Why wouldn't you need a smaller amount that would allow you to achieve earlier milestones and maybe prove the value a bit quicker?
Has there ever been a proposition that's come to you and you've thought, oh my God, now's the time I need to invest? I know that you're talking a lot about long game, and you want to build the relationship and you want to see progress, and your initial approach might have interested you, but then you want to wait 6 months. Has there ever been an occasion where it's like, I need to act now on this?
No, not once. Not once.
And you don't think there ever will be?
I don't know. Maybe. Yeah, it would depend on the circumstances of the opportunity. But I don't want to be rushed into something because I might in the end be the wrong fit for that team and they might be the wrong fit for me. So if somebody's in a mad rush to do something, that's probably not the pace I want to go at. I'm not slow or difficult or cumbersome or any of that type of thing. I think I go at the right pace for both sides. And I think in the end that means more likely than not you marry the right people.
And what sort of time periods are we talking? What sort of a short case time frame and a longer case time frame for you?
I think 3 months is short.
3 months is short.
Yeah. By the time you've had some chitty chat, by the time you've seen it, by the time you've looked at it, by the time you've thought about it, 3 months is pretty quick.
Yeah,
I think.
And what's been the longest one?
I probably took 6-9 months to have.
Okay.
At the earlier stage, you don't. Yeah, probably 6 or 9 months is what I've looked at doing stuff.
Okay. That's interesting. I thought you might sort of say maybe a year or a couple of years or something like that.
No. It's
right.
I'm at the earlier stage, so if something hasn't
That's too late. It's gone, right?
Yeah, it's probably hasn't gone anywhere. But it's not quick. You don't send somebody a pitch deck and say, please can I have some money, there's the bank account and sort code. You just don't do that. It takes a bit of time and for both sides. Otherwise, neither side get what they want.
Have you seen a change in investor appetites in the last couple of years? Do you think people are a bit more cautious now? Or is that a myth?
Yeah, so oops, sorry. So the really interesting thing about investing, and certainly at the stage that I invest in, is your job is not to get your money back. Everybody thinks that, that if you're naive, you think getting your money back or one times your money's good. You've actually got to hit the ball out of the park once every so often. You've got to get a thing that returns 50 or 100 times your money, because that pays for all the ones that don't work. The things where you're just a bit too early, or you're just a bit too late, or the team aren't quite what you thought they were, or competition's too severe, or the product didn't work. And you make a lot of bets as you go along. Now, some of those bets aren't right, and the best technology doesn't always win. In the classic sense, Betamax was the best video technology, but it didn't win. VHS won. And it's the same with a lot of other stuff. So there's a lot of things got to go right to get a return. And therefore, if you're only targeting your money back plus a bit, you're probably not going to be in this game very long. You do need classic VC strategy, classic investor strategy. You've got to be planning or expecting or hoping to hit the ball out of the park once every 5 or 10 years. You have to.
I want to ask you a question about a kind of imbalance between what companies perceive, like their brand, their marketing strategy versus their product. And have you got an instinct for possibly products that you think actually are inferior compared to other products that you've seen, but the marketing is so good that you kind of back them on the basis of that? Has that ever happened?
Yeah, so the quality of the product and whether somebody's in love with that product, it is only important if it's the customer telling you that. So if the customer is buying Apple product, and basically they're outside the shop waiting for the iPhone 15, and you interview them and you say, what have you bought? You say, I bought the iPhone 15. Great. How much was it? If the customer says, I don't know, which they do, you think, wow, that is, I've won there. That is the answer there. But at the other end, if you go to one of the low-end clothing shops and you buy a T-shirt, you're not going to come out and say, I love this T-shirt. This is the greatest T-shirt ever. It is what it is. You're going to wear it a few times. You're going to get some sauce in it. You're going to put it in the bin. It's where you sit in that stack. And it's not what you think, it's what the customer thinks. If you're engineering a product based on what you think rather than what the customer thinks, that's a big mistake. You end up over or under engineering a product for a customer. I mean, you don't see Apple having cheap mobile phones, do you?
No,
just keep going up and up and up. It's the same with Rolex. It's anybody who's got that, the luxury clothing people, the sports cars, they've all got the same thing, that quality for the market that's appropriate. And it's the same at the budget end. In fact, I think the bit that everybody should be concerned about is that horrible middle ground. So the middle ground in most markets is very tough, very, very tough, because you haven't got a quality differentiation or a price differentiation. Your product's okay, your price is okay. Really? Yeah. Is that what you want? I'd rather have cheap and cheerful or high price luxury. That middle bit's horrible.
Yeah.
There's very few. You've only got to look at the high street, and look at the top shops, the Burtons, all those types of people that just got squished in between. There's only really Next and a bit of River Island that's survived that mid-market bit.
Absolutely. I suppose what I'm trying to get to is I'm sort of wondering from an investor point of view, how much value you put on the branding and that customer loyalty. And is it just about that? Because I guess if you say a great product with a potential great market fit, but the branding is bad, is that something you can go in and fix? Is it easier to fix that than the other way around? Like you see a great product, you see a great brand that people are buying, but you can see flaws in the product which might harm it long term. I mean, how much assessment do you give to that sort of product versus brand and perception?
Yeah, I mean, brand's something you build over time, isn't it? It's about we believe. it's the classic thing. What do we believe? That's what the brand is all about. But it's got to fit the target market you're aiming at. Using that example, that Rolex would not do well in the budget watch market. No chance. You build a brand based on the market you're trying to target and why you think that market's attractive and accessible and sustainable and all. Why you think your proposition fits that market and the brand goes around it. I think it's not the other way. You wouldn't build a brand and then wonder what market to put it into. But it's a bit like Lucozade. When I was a kid, Lucozade was something you drank when you were in hospital. And it came in a horrible bottle with a brown paper around it, and and it was you drank it when you were extremely unwell. that was the market, and all they did was shift it to a sports market and say it's the same thing. But then they changed all the packaging, they changed the brand, they changed the way they positioned it. Nobody drank it in hospital anymore. It was a complete position of the brand to the market. The market comes first. In my mind.
I'm old enough to remember what you're talking about, and I remember I think they signed Daley Thompson.
Correct.
Daley Thompson was the face of Lucozade, and then it was an athlete's drink.
Yeah. So that's exactly what I think. So, that you've got to get that product market fit. You've got to get a brand that suits that. You can build a brand. I wouldn't waste all my money building a brand if I couldn't sell the thing. You evolve that over time, and it's always we believe. We believe this, we believe that. That's what brand's all about.
Yeah, absolutely. Okay, well, I'm asking all investors this, and it might be a bit of a painful question, and by all means don't answer it, but was there one that got away? Was there one that you wish you'd invested in but didn't?
I don't think there was. So if I didn't do an investment and somebody else did and they did really well, then first of all, I'm pleased for management and I'm pleased for the investor. And there was a reason I didn't do it. And sometimes it might be that I was just lazy. Sometimes I didn't see something somebody else saw. But it is what it is. I wasn't. It's not like there's a finite number of deals to do here. It's almost infinite. There's a lot of, there's much more deals than I've got firepower.
Yeah.
So I would think the opposite. And you can't spend your life being grumpy that other people have been successful. I couldn't be any more happy if another investor makes money off a deal. That's great. I'm really pleased with them.
On the other side of that, has there been an investment that's come across your doors, across your desk, and you've said, this is not right for me, but I know who it is right for, and you've recommended to another investor?
Yeah, there's things in the energy market and things like that which I just don't understand. Business to consumer stuff is not really my strong point. So I have, if it's not for me, geez, you help your ecosystem, don't you? You help your friends, you help you. There's not really competition here. There's just not.
See, this is the difference, because I think from a sort of founder, I mean, you must have experienced that as a founder. You're thinking, you look at all the other IT companies and think, well, they're all competitors and you might really want to share stuff. But in the investor space, it's not like that, right?
It's not even in the real market. You have competition, of course you do, but you tend to coexist in accounts with people. It's not like sole supply type stuff. You just don't. That it's not as competitive. I mean, all right, there is always somebody who's the enemy. Of course there is. I think that's healthy. If there isn't somebody who's the enemy, that tells me about the market and competition piece. Does.
Yeah, absolutely. Well, before we go, I know that you're a massive reader and you must have read some really high quality business books. And I've got a few here, and I wanted to play a little game of like Snap and see if any of the maybe your top 10 or whatever business books that come to mind of something I've got next to me now. So what would you be your sort of top 10 or top 5 books?
Oh, no, that's difficult.
I've just sprung this on you because I didn't. So I just sort of sprung this on before we started talking.
Yeah, so you come to things you've read earlier, more recently, should I say, before you go backward. So things I've read recently, I read $1 Billion Loser, which I quite liked. I read the Lex Greenhill one, which are two business books about the similar thing, which is people who grew big businesses out of hot air, basically. There's a couple of the Goldman Sachs ones and the Rothschild family, which I've read in relatively recently, which are great stories and are about history and legacy and how you build stuff. They're good. I love the Warren Buffett book, Snowball. That is just, I mean, he's just the brightest, smartest, cleverest guy I can ever imagine. You know, but he talks about sticking in the market and domain knowledge, and you know, why would you go elsewhere, and total addressable market. So those books are really good. They're helpful. I'm reading the one at the moment about Cazenove Bank, which is a 1776 bank that turned into during the 80s turned into a big merchant bank in the UK and internationally. So that's quite interesting. Branson's books are pretty good as well. That's probably a few of them.
Cool.
What have you got on your list? And
okay, I've got this one. 0 to 1. Peter
Yes,
Thiel.
I got that. Peter Thiel.
Yeah. I've got Work the System.
No, I'm with that
Sam
one.
Carpenter.
No.
And this quite new one. $100 million offers. Alex Hormozy. Oh, really? Oh, well, there you go. There's some good ones there.
Have you got my home address?
No, but I'll email you the titles.
Absolutely. No, thank you.
They've really changed my thinking. But
David, that's so generous of you. Thank you so much.
No worries. All right. Well, I thank you so much. I really enjoyed the chat. I hope you've enjoyed it too. Some brilliant nuggets of information there, which I'm sure that the listeners to this and the watchers will absolutely love. So just thank you again for your time.
Awesome. Appreciate your time. Take care.
Take care.